Hello, everyone, and welcome to October. October has begun, September is gone, 9 months of the year is gone, and here we are for the last 3 months of 2022, which everybody is calling the end of the world. And you know what, man? I'm pretty much done with all these comments and projections of people who have bought Twitter accounts, have brand new domains that aren't even a year old, and are giving you quote unquote expert advice about bear markets, having never even been old enough to have traded when the original bear market was around back 2007, 2008. So, anyway, I want and I will continue to enforce that you remove all of this noise and all of this problem of trying to play calls and puts in an extreme VIX kind of trading center and focus on these SPX spreads, which I am now giving out every single day. And that is the one and only focus that I am dedicating to, along with the guidance that I will normally give intraday and, you know, pre-market for everybody who wants to ask about any other ticker out there. But I behoove you to please go contact your trading platform and make sure or find out whatever you need to do to get in to be able to do daily SPX spreads and start printing yourself some fucking money. I do this with my own clients that I manage a fund for, but because I only focus on getting 5 to 10%, nobody wants 5 or 10%. Everybody wants to hit home runs. And last week, it was trending on Twitter, Tony Gwynn. And I'm wondering, fuck, man, this was good. This was one of the guys I idolized as a baseball player when I was a teenager and tried to mimic, even though I wasn't a left-handed batter, how he approached the pitch. And I see it, it's trending on Twitter, and obviously I'm turning 50 last week. I'm intrigued. And I see they're talking about Aaron Judge over at the Yankees and how Aaron Judge struck out 167 times this year. Tony Gwynn has only struck out 167 times during the entire 1990s. And it hit me between the fucking eyes like getting hit with a truck. You know what, man? If you guys can't handle, seriously, if you can't handle growing an account and printing money as risk free as possible, go fucking find somewhere else to go, man. Really, seriously, because we're in an inflated high volatility, not even high volatility, but we're in an inflated VIX kind of situation that we've got going on here, where it's expensive as hell to play calls, it's expensive as hell to play puts. You've got to be there and be able to nano scalp this stuff. And if your wife likes you doing that, great. If your husband likes you doing that, great. If your kids like you doing that, great. If everybody loves that you're losing money consistently, because it doesn't matter how fucking good you are, this is a tough market to trade. Do whatever the fuck you want to do. For me, again, going back into this and focusing on these spreads, I'm looking at making $50 on $1,000 spread, 5%. That's why I'm giving you these exact strike prices to take prior to the open and within 2 minutes after the opening bell, so that you know what the actual level is that you want to be going to get paid. Ask UT Miner, 3 days, $1,000 risk, he made $700 fucking 3 days. He's almost doubled his portfolio, which is what I have when you get down to trade number 20. Trade number 20, which is after 20 trading sessions, which is 1 month. You get 20, 21, 20 trading sessions in the course of a month. Doing $50 a day, you're already up to $1,000 in profit, so you can go to the next level of trading $2,000 a contract. Trading $2,000 meaning trading two contracts only. Within 10 sessions of that, you're up over another $1,000 and you're able to go to the next level, which is trading three contracts. By the end of the 37 sessions, so literally within 2 months' time, you're now above 3 contracts, you've made over 3 grand in profits, and now you're starting to trade 4 contracts, and it just starts to steamroll. It steamrolls so quickly that as you get in to your third month, 60 trading sessions, 60 trading sessions. You're trading 10 grand, 10 contracts, and you're making $1,000 a day. That's 60 trading sessions. Give it another month. 80 trading sessions. You're trading 20 grand. You're trading 20 contracts, and you're making $1,000 on that every single day on the 20 contracts. I was wrong with what I said there on the 10. Okay, I was wrong. When you're trading the 10 contracts, you're making $500 a day. I was wrong. I was wrong. I was wrong. I was wrong. 5% on 10 grand, $500 a day. It's not making $1,000 a day in 60 trading sessions. You're making $1,000 a day after 80 trading sessions using this system, okay? Using this system of only 5%, you're up there trading 20 grand, 20 contracts, 5%, getting $1,000 a day. And when you come back up here and start looking at what you've got, at $50 a day, you're making 12 grand a year. So you're buying Happy Meals. At $100 a day, you're making 25 grand a year. So you're paying your electric bill. $200 a day, you're up at 50 grand. Now you got a second job. $500 a day, you're making 100 grand. You're making basically what every millennial out there is making. You start making $1,000 a day and you start making $2,000 a day, you can start to see how this all really starts to stack up in your favor. And all that you're doing is sitting back and printing money. Because again, on these SPX spreads, I'm giving you exactly where to get the calls above, where to get the puts below. I have back tested this, I have used it, and again, where I start to highlight in red stuff that did not work, it's stuff that we would never have traded anyway. And because you had the CPI report back there, you had the FOMC meeting over here. Charts are charts, and we know what charts are, and we know what charts are expected of. And again, these are looking at closing at the end of the day, cashed out, full, getting the full premium. When was it on Thursday? Thursday, I think it was Thursday. I'm giving out the trade, and we're playing the put side. It's paying you $3. It's paying you $2. It started out, it was paying almost $1. We're only looking for 50. We're looking for 50 cents. So you're already getting a benefit of having even a better return earlier and faster on that table. And again, I could explain this a million different ways to anybody. If you can't see it, I can't open your eyes for you. And again, I'm going to continue every single day moving forward where this is going to be the primary focus. Print the money, because I'm telling you, the shit and the noise out there is not worth actually fucking listening to. Everybody's trying to compare 2008 to where we are today. They're all trying to say it's identical, it's exactly the same. You know what? I'll agree with you that it is pretty much coming right to here. Bang, bang, bang. As we went into February of 2008. Yeah, I'll give it to you, okay? Here was where we touched the all-time highs. We had our decline. We came up here to July 2008, and then you had your descent. I'll give it to you, all right? I'll compare it to you with right here with where we are. Where, if you're going to go and look at the numbers, you got 700 points down over there into Russia's invasion. 520-point rally up there to 46.37 into the end of March. 1,000-point drop as we went over there into the end of June. 688-point run as we went up there and touched that 200-day moving average. And now we've just had a 741-point drop right down to the September of 2020 highs at 35.88. We missed it, or we touched it by a penny, a couple of pennies. Right there, 35.88. We're down here at 35.85. You can do whatever kind of voodoo magic and, oh, well, this is the end of the world kind of stuff that you want to do. If you're doing these spreads every day, it doesn't fucking matter. It really doesn't. What everyone wants to go out here and expect and try and say is, well, the forecast is going to be this, and now the Fed's got an emergency rate hearing on Monday, and Credit Suisse is rumored to be in default because of the way they're doing their credit default swaps, just like in 2007, but even worse. You know what, man? Who cares, really? At the end of it all, who gives a shit? Back here in 2007, we had come up here and we had retouched within a penny the .com highs. We had our little bit of a dip, and that was the first time that Ben, what's his name, came out and did the rate cuts. Came out and did a rate cut, and from that rate cut, we had our rally over here in August up to that October 11th, 2007 high, which was the financial crisis peak, right there. From that, we had another rate cut in the middle, then we had a third, then we had a fourth, then we had a fifth, then we had a sixth, a seventh, and eighth, and by then everything was completely out the window and it was gone. But I had gone over this back in March and back in April where we were having multiple week declines where you don't see three often. When you do see three, you almost never, ever, ever see four. So here we go. Back over here in December of 2007, we had 1, 2, 3, 4 in a row. Then we started having our little bit of a bounce. Back over here in 2008, you had 1, 2, 3, 4, 5, 6. I highlighted this as we went over this back in March and April when we were having the multiple week declines, which again were extremely rare and have only happened 6 times since 1987. So then we come back over here and we had our little bit of a relief bounce, 3 red weeks in a row, 2 big green dojis, and then again 3 red weeks in a row to the downside as we went into that October of 2008 dip. A little bit of a wiggle, and then we had our big drop over here in November, which was where the NASDAQ bottomed 3 weeks in a row. Bang, bang, bang. Again, 4 weeks in a row over here in 2009 to start it off, 4 weeks in a row as we went into that March 2009 bottom. Now, since we have hit that March 2009 bottom, you can scroll through and go through all of it. You had 4 red weeks in a row over here in 2010, which was the end of wave 1. You come back and you start going through everywhere that you look. You had 3 in a row. Here you had 3 in a row. We've had 3 in a row quite a few times before. Here was 4 in a row back in 2011. Again, 1, 2, 3, 4, 5, 6. Highlighted this when we were in April, how we had 6 in a row back here in 2011, even though we didn't get any kind of decline. Come back again, and here you go, 1, 2, 3, and 4. As we start heading into another 3, the move up above the .com and the financial crisis highs of 2007 over here in 2013, everything starts to change as the bull run has become more or less official. 1, 2, 3 over here in 2014 at the beginning of the year, and again here 1, 2, 3, 4 as we went into the invasion afterwards of Crimea in 2014. 2014, you had 4 in a row as we were going in there to October. October is where we are right now. As we come in here to the wiggle that we had going from October all the way into February of 2016, as you can see, we wiggled in this range for over a year, produced absolutely nothing, had 3 red weeks in a row after we had made our first interest rate hike since the crisis back here in December of 2015. And onward and upward we went. Again, another 3 in a row right here before we went into Brexit. Another 4 right here, which was Brexit. Boom, right there. And we start to progress into Donald Trump. Donald Trump comes in here into 2018. And again, 2, here's 3 in September. Another 3 in December of 2018. We had 3 over here in June. And again, we're over here now into 2018, into the pre-COVID high, and then you have COVID, and you have over here September of 2019, 3 in a row, boom, boom, boom. And then we had that big, massive rally that we had back there. COVID, 1, 2, 3, 4, and 5. COVID, COVID, COVID. COVID is COVID gone. 1, 2, 3 over here in August going into September of 2020, which is what I highlighted earlier where we pointed to. Here was another 3 back in October. 1, 2, 3, double bottom, double top. Joe Biden wins. and we go into where we are now, which again, where we are now is very confusing for people because it has just been a continued decline, which why I'm trying to highlight when we look over here onto the charts themselves. We had a 700-point drop. We had a 500-point rally. We had a 1,000-point drop. We had a 688-point rally. Then we had our 741-point drop here, which again takes us to the September 2020 highs. Almost to the penny, almost 50% retracement of COVID. And anybody who plays around with the Elliott wave and likes to look at it, they start going, wow, look at that. It looks like it completed 5 waves. 700, here's your A or your 1, here's your 2, here's your 3, here's your 4, here's your 5. 1 equals 5. Your 4 is a little bit longer than your 2, which impulsively can be done. Come over here onto your weekly, and on the weekly channels or charts, we start looking here that, look at this. The SPX has come down to the 200 weekly moving average, right down to it, almost to the penny, 35.89. We closed at 35.85, right down there. We broke it during COVID. As you may be able to proceed and look over here, it kind of starts to look like you've got a little bit of a buy divergence over here on the weekly. Your stochastics are extremely oversold, and your money flow is not rushing out the doors as it was over here into June. So again, something to look at. When you zoom out a little bit further, you can see back in December of 2018, after we had that 20.02% correction, which was again due to interest rates being too aggressive, we came down and we tagged that 200 weekly moving average on the SPX almost to the penny, and obviously got what we got. Over here in COVID, you can see what took place. We broke below it. We were down below it for a couple of days, a couple of weeks. Bang, algorithm looked at values, started looking out at it, and again said, we are going to buy this. That's what they did. So you come over and you start looking at your money flow and looking at it aggressively, and you can see, yeah, we're not in an extreme bull market, but we are very oversold. So again, come out here and start looking at it from a much more zoomed out point of view. And you can see how after we got it back over a crossover back here in 2011, 2012, when we visited this 200 weekly moving average, we came down and we tagged it in February of 2016. Tagged it right there. Tagged it 2018, busted it for a couple of days over here in 2019 in COVID, and here we are again right here tagging it to the penny. So again, there is millions of different reasons why this could, should, might possibly be the completion of this entire decline. But again, one of those things that we need to go and look at and monitor and see what we get. Over here on the daily, you can see you have a very fractional attempt to get a buy divergence over here on the RSI 14. Over here, looking at the Keltner channels, standard Keltner channels, been riding that lower Keltner channel all throughout these dips. Here we are again, riding this lower Keltner channel. We're going to need to see a return upwards up to around 38.50 in order to start saying that, yes, this dip is complete. Again, looking at your full stochastics, you can see that you've definitely got a buy divergence over here. And on your money flow, it has never, throughout the course of the entire year, never been as oversold as it is currently on the money flow 14, which again, when money all empties out, there's nothing for it to do except for it to go back in. So again, you've got more reasons to start looking at this and considering why you don't want to be aggressively playing to the put side. And again, you don't want to aggressively be paying to the upside. NASDAQ, 200 weekly moving average, bang, right there. Bang, right there on COVID lows, and bang again over here on the 2018 lows. Could be wrong as far as, hey, maybe you guys are right. This is not going to work this time, and it is going to break down below it. Okay, here's how you've been trending all throughout. Since you came back up above it over here in 2010, having had that bottom over there in 2008, 2009, 2010, you recovered this 200 weekly moving average, and we have continued to progress strongly, avoiding it at all costs all the way through. And again, we have only made contact on COVID, and again, right here where we are right now. So, again, it's your judgment on how you want to look at it, but I would strongly suggest that when you start looking at how we have declined and how this VIX has continued to fail and only get up into those mid 30 levels, there is a plethora of data out there that wants to tell you that the Bears need everything to go right for them, and all the Bulls need is one. We have the jobs report coming this Friday. We have CPI coming out next week. We have this secluded Fed meeting that's due to take place on Monday, which everybody's rumoring. We have the other rumors, which were like last week's, that Xi Jinping was under house arrest. Now it's Credit Suisse is into default because the CEO just happens to be named Axel Lehman, and everybody's making a joke on how it could be a Lehman Brothers effect. So, in any way, I'm not angry or upset or anything, but yeah, I go out there and I see what everybody else is talking about. When I'm going to go to sleep, I'll listen to a couple of videos and see what people are doing. And you know what, man? Again, if you want to work hard and you want to hit home runs, hey, man, I applaud you, man. Fucking go do it, man. I did. I missed a 600-pound deadlift on my birthday. I was only able to get 580 pounds. I was able to get in there on Saturday and rack out 385-pound bench press. I'm 50 fucking years old. You know, congratulations, yay, you did the big heavy weight. So fucking what? So what? Same thing with these trades, man. If you really want to go out there and you want to try and hit a home run and throw $700 at a 2-day expiration Tesla contract, man, again, I congratulate you, man. I'll give you all the chart data that I have in front of me, and I really, really hope it works out. But if you don't want to come out there and just make it fucking simple and take the time to not try and go on some crash diet to get 6-pack abs in fucking a week, take the goddamn spreads. Take the spreads, do iron condors with them like UT Miners doing. But for fuck's sake, man, the money's here, all right? And I'm focused on this. If somebody told you I'll give you 5% more on your salary, you're going to turn to them and say, no. You work for those people. This is you working for yourself. Stop being so greedy. Let's make some fucking money because we got 3 months and I am going to make at least 3 of you by the end of this 3 months. You're going to be at that level. 80. You're going to be at that level where you are doing 20 grand a day, making $1,000. We only got 60 days to get in there, and in those 60 days, that's where we get up to 10 grand. Because you guys are making more than this 5%, like UT Miner made 700 in 3 days using $1,000 risk, I am going to get at least 3 of you up here. And if nobody else wants to follow, I really don't care, because I am going to make sure that the people that want to make money are the ones that I'm going to pay attention to. The ones that want to gamble, I'll answer your questions. I love everybody, but at the end of the day, man, this is a time when we really, really need to shut all the fucking noise out and let's start making some money for everybody.